Welcome to my YouTube channel. My name is Tabitha, and today we are going to talk about interest on mortgages. So, this is the topic of today. And if you're new to this channel, please subscribe for more videos, and I will appreciate your business. So, we are going to talk about interest on mortgages, and these are the agendas of today. Number one, types of interest and mortgages. Number two, how to get deals. Number three, renewing or refinancing. Number four, recommendation. So I am really stressing on renewing or refinancing. This is a very important point. And if you would like to learn more about this, since most of us, we have mortgages and all those stuff, we have to know what really happened when we are renewing and what really happened when we are refinancing. Stick around and watch this video until the end and give it a thumb up and comment, and I will appreciate that. So let's go ahead and look at type of interest rates. So type of interest rates, there are common ones, and then there are many of interest rate out there, but the one that are mostly used on the mortgage side, the fixed rate, and the other one will follow. So fixed rates and payments amount remain the same for your entire terms. Most of the time, people take 25 years of amortization period and 35 years amortization period, but most of the time is not really full term. So it's broken down into smaller terms like 5 years, 10 years as they renew as they go. So when you choose fixed rate, so every time that they will give you, you'll have to renew it again. So maybe you have an option of choosing a different type of interest rate if your terms end. Because some mortgages, they start, some amortization periods, they start with 5 years, maybe 10 years until you finish your full term of amortization. So this is one of them. Fixed rate. They offer financial stability, but usually start at slightly higher rate. So this is really very important because your payments are fixed. So there's no way the bank can adjust and make money. So they will charge you higher rates. Another type is variable rates. So variable rates, it fluctuate with your lender's prime rate. So every time the interest change, they also adjust your interest. So your payment will also fluctuate. So in this case, it has to be people who are really prepared to know if the interest change next time, can you be able to afford the difference between the previous interest that you were paying and the new one? Or is it lower? Is it higher? So you have to keep up with that information as you go. So this one, payment or amortization period will adjust when rate change. So it fluctuates all the time. So let's look at the type of mortgages. So one of them is open mortgage. So the open mortgage allow you to pay off your balance at any time without penalty. So there are no people who can really pay it off. No, I'm not saying no. There are some people who can pay it off once they have that lump sum, but other people, they have that privilege of paying their principal every time they have some cash. They run and pay some without any penalty. But another type of mortgage is also closed, but it's not completely closed. You have that room where you're given some limit to prepaid your principal amount to some extent. So, and you are not allowed to go beyond that amount. And if you go beyond that, and then you will be given penalty, which is ironic because it's a loan and you shouldn't be punished for paying it off if you have the cash. But these are the rules, right? They are bank rules. So whatever you choose and you signed, you have to follow, right? If you have the closed mortgage and you have a limit payment for prepayment, and then you stick to that. So I remember BMO used to have like 22,000. So if you have mortgage with them and you have the closed mortgage type, so you have to pay, you have maximum of 22,000 to pay toward your principal without penalty. If you pay more of that, and then you will be punished by paying some amount for going beyond the limit. So those are the type of mortgages that we have. Sometime you want to get deal, compare market averages, and review current offering across the local market using tools like the government official websites. Educate yourself on rules and amortization option using the government Canada interest on mortgage. So there are a lot of information out there. So you can really look at them, educate yourself so you know what you're really dealing with. So let's come to the main thing. The main thing after your first term, let's say 5 years. For example, I have a 5 years term until I renew my mortgage. So renewing, so when that thing ends, so they will have to assess your affordability ability to to continue the mortgage or not. So after 5 years, they will have to assess, for example, like interest rate might change to higher rate at this time. So if it change to higher rate, so they will have to assess your ability to afford. If you cannot afford, maybe buy, let them get the house and they resell it, and you remain with nothing. So do you want that to happen to you? So let's go ahead and see. For example, let's see 2020, there were lower rates in interest, and a lot of people were intrigued to buy houses at that time. And if they had no financial background about interest rate and how interest rate can change or fluctuate over time, they put themselves at risk. And maybe some people now might have lost their houses because of lack of that information. So if you had a house for 400,000, 25 years, and interest rate of 1.5%, you were only paying 1,900 monthly on your mortgage as a mortgage. That one. So, but 25 years later, 5 years later, you have a less principal amount and you have 20 years left, but the interest rate jumped to 4.5%. You see, so interest rate, when it goes up, it will always increase your mortgage payments. So at this point, you have almost 300 extra. So if you don't have that amount of money, you are not prepared, you don't know where to get that 300 amount of money, your affordability will be tested and you might be at risk of foreclosure if you cannot afford it, right? Because their payment has to come on time. Yes, it has to come on time. So that's it. So at this point, you will see if you can afford it or not. If no, then they will foreclose you and sell the house and get the thing. Other people who cannot renew, they can refinance. But there are also risks and conditions that come with refinancing, right? So what happens when you want to refinance, if you can't renew and you can't afford, and you do not qualify to refinance, so they will foreclose your house and they get the house and they get your down payment. They also get your principal interest that you have been paying. So and then maybe you might even end up being in debt instead of this big dream that you want to own a house and maybe rent it out or do this, it will all be left as a dream. So my point is, if you want to really have a house, do your calculation, add your numbers. Can you afford? What if? So in this world of business, this is where like the pessimist to be like a pessimist you is allowed. So you can really calculate, what if this thing goes wrong, how can I handle it? What if this thing goes wrong, how can I handle it? It's more prepared you to manage the risks that could face you in this business field. So if you really anticipate and see, not wishing, but see the possibility that this thing could go wrong and this is how I can handle it, and then you are more prepared than waiting, and then now you're panicking, you don't know what to do, and you're losing instead of gaining, or gaining what you have been working for. So refinancing, so if they see you're a good customer, you cannot afford, and you cannot afford the renewals, they will give you an option of refinancing. So this is to extend your amortization time to accommodate your affordability. So if you cannot afford now with renewal rates of 4.5, let's extend your amortization time. So it's totally like a different agreement, not from the previous one. So you are starting your loan again, and it has to be extended. And this will give you lower payment that you can afford, and then lower interest, but higher in the long run. So all of those things will go, you have to pay less, make more, the bank will make more in the long run. And if the value of the house is down, some financial institution, they will say no, they will not let you refinancing. Why? Because what happened is, if your value of the house is high, so they see like in the future, if you continue not to afford it, they will resell it, and then they will make the profit, right? They will be able to repay them back and give you the remaining amount of money that is left. But if your house is depreciating, is losing value, and then they are the one taking risks, right? They are the one taking risks. You might not be able to afford your mortgages for your own reason and all those stuff. And they will be forced to foreclose you and lose, right, at the same time. So they will foreclose you, they will refinance your mortgage if they see your house has value. So it's not like really a good idea. So what are some of the important things that you need to do before you go into this situation of refinancing, huh? Because it's not a good situation. So for you to afford that, to avoid that, you have to make sure that the mortgage amount you can take, you can afford it, right? If you can afford it, you calculate, you put it yourself in the range that you can stay in comfortably without overstretching yourself, and then you will not need to be refinanced or begging the company to extend your mortgage, which means putting you into amortization for life. Maybe if you're not responsible enough to keep your mortgage, to manage your loan, right? Because mortgages are loaned and they amortize over a long time, right? So which means it will be robbing you more interest as the rate increase and all those things. So save more money for the renewal rate, right? So you don't have to be stretched out when that time come. Do not refinance, because if you are able to renew, do not refinance, because refinancing is like you're restating your mortgage amortization period and it will extend, which means you will lose money over time. It seems like it's cheaper, but over time you're going to lose money. This bank who is going to make more money out of you, and renewal is the best way because you will be reducing your principal amount every time you make a payment, and then your credit history is going to go up too, and then also your interest rates is going to go down too, because most of the time they prepaid their interest. So if you're making constant payment every month, over the years, most of the money that you pay will switch and start going toward your principal, and you will see your amount going down a little bit. But if you extend doing the refinancing, you are extending, which means you're giving them more time for them to continue collecting higher interest from you than what they put towards your principal. I hope that point is clear. Renewal is better than refinancing, and buy houses that you can afford, or do not overstretch yourself. Work with your numbers. It's not about what other people are doing, but what you can afford. So if you're new to this um, channel, please subscribe for more videos, and I will appreciate your business.